You may have heard it said that taking a policy loan is the way to finance everything.
You are listening to Wealth Talks with the McPhees. Is it a good idea to take a policy loan when you're using life insurance for self-financing?
Well, policy loans is a very easy way to have financing available to us and a way for us to recover part of the interest on certain financed items so that we're not paying all that interest to a third party. Some people think that all that interest that you then pay comes back to yourself, but that's not true either, is it?
Not exactly. And for those of you who listen to this show regularly, you know why we're using life insurance in the first place. If you're new to the show, we'll just do a quick review here. We're using the life insurance because it's a great place to store our liquid, quote, savings, if you want to call it that, because the money is still accessible to us. And not only is it liquid, it gets a better than average return on what you could get in a savings account. If you look at the cash value growth over a long period of time, and you're getting protection. So in 2 words, it would be time and protection that we're getting by using the life insurance. Time to look around to see what type of opportunities we want to use that money for. Taking a policy loan is a great way to access the liquidity that builds up in a policy without touching the protection element, the death benefit that is building there for us. So when we go to take a look at using a policy loan, there will be some interest on that policy loan that's due to the insurance company. So when we're thinking about whether to use a policy loan or not, we need to think about the interest, don't we?
We do. And that brings up the point that when you take a policy loan, your policy is acting as collateral. The death benefit that you have paid for, called paid up insurance, becomes the collateral that the insurance company holds and allows you then to borrow their money. And so that's why there's interest that's going to be lost or paid to the insurance company, which is good. You're a participating owner of that company if you're working with a mutual company. And those interests that are paid on policy loans by policyholders are going to drive up the profits of the company. That's just one of the reasons why it's good to be able to access money from a policy. However, if I can finance something at a much lower interest rate than what a policy loan is going to cost me, which is the best way to do that?
Probably to go with the lower interest rate. You have your protection working in the life insurance. You have your liquidity there. If you needed to take a policy loan to go make some payments on your other loan, well, you have even the cash flow to do that.
And, even then, it's not a hard set yes, because maybe I want to control my cash flow on a month-to-month basis. And with a policy loan, I can take 5 years to pay off the loan, whereas if I financed it someplace else, I'm going to have to pay it off in 16 months. Then that's going to allow me to have a lower payment month to month to the policy loan than I would with a third party.
That's true.
So it's all about money management here, and which is going to be the most accessible, which is going to be produce the better cash flow for you on a day-to-day, month-to-month, year-to-year basis, and which one's going to keep more money in your pocket.
That's right. Yeah. And so it's really about, some people look at this and say, well, if you don't always want to take a policy loan from the life insurance policy, why would you start the life insurance in the first place? And that's because it's getting us the protection and it's getting us more liquidity and options.
And the bottom line is that we're in this for a long period of time. This isn't a short-term purchase. This is a lifetime purchase. And over our lifetime, once the policy has produced that guaranteed return, we'll have more money to spend and use out of the policy than we've ever funded it with.
Very true.
And so we have to look down the road. And if you never start, then you'll never get there.
Mm-hmm.
So sooner is better. and sooner is best.
Always, always. When you're talking about time and money, you can never exchange one without suffering in the other, because they're tied together inexplicably,
It is.
inescapably.
You know, Nelson Nash always said to me, he said, Tom, all money has a cost. So what are you paying yourself for the use of your own money? You would pay someone else for the use of theirs, so what are you going to pay yourself? And that's an important thing to consider when we take a policy loan or decide not to take a policy loan, is what can we afford to pay ourselves back for a policy loan that we take? Mm-hmm. We should be paying back more than the interest that the insurance company charges, because that is one way Mr. Nash was able to recover the interest that was was flowing to other people in his own life. And that's why he wrote the Infinite Banking book in the first place, is that if I'm paying 16 or 17% to a credit card, and I can only have to pay 5% to an insurance company for a policy loan, I shouldn't stop paying the other 11% just because I financed it through a policy instead of through my credrit card.
Sure. Keep the same cash flow.
I want to keep that 11% for myself. If I don't, I'm cheating myself and not being honest, as what Nelson would say.
Yeah. So some people look at this and say, well, if it's a good thing to take a policy loan in some cases, which it certainly is, well, then shouldn't you try to get extra money into a policy so that you can take an even bigger policy loan to finance? Maybe you have a project coming up. Let's just do an example here. Let's say you have $100,000 available in capital right now. You might structure that to go into a $20,000 policy that would fund the first five premiums, the first 5 years of premiums on that policy. But your first year cash value, when you pay the first $20,000, is going to be about $12,000 on that type of policy. Let's say that you have an $18,000 expense coming up later this year that you think you would like to finance through a policy loan. Should you try to do a bigger premium amount so you can borrow all $18,000 of that from the policy?
Well, I know that a lot of people would say that would be a good thing to do, but what we have found in our research and careful study is that usually doesn't really pay off. First of all, to get that extra money in there, you often need to add a term rider to the policy, because if the policy has been designed to maximize the paid up addition rider according to the IRS 7 pay test, then getting more money into it than what is allowed in that 7 pay test would have to require a term rider to adjust the death benefit upward. Now, that in itself violates what Mr. Nash taught us, is to always create a policy with the lowest death benefit possible, with the highest cash values possible, with the most affordable premium that is comfortable for the client.
And I think that's the real key there, is what is affordable and comfortable premium on an ongoing basis. Here we had the $100,000 we wanted it to pay for the first 5 years of premiums. There's going to be some cash flow, obviously, that's required for continuing premiums, perhaps at a lower level on this policy, the way that it's designed. If we add a term rider in here, that can decrease those premiums in later years, but there's also going to be a cost to borrowing the money right back out. For example, to finance this $18,000 project, you still have cash in your $100,000 fund over here that's going to help pay your premiums. Couldn't you take a, quote, loan from that just as easily and not trigger any policy loan interest?
Yes.
And use that and make sure that you have it paid back in time to make the other premiums on the policy?
That's exactly right. And that's why we always talk about this is a money management system. It's not buying as many life insurance policies or overfunding them as high as you can. This is about what is going to keep most of the money that you make in your control, rather than losing it to interest in some other fashion. So what ends up happening is that you, by having to pay interest then on a policy loan that you took by overfunding a policy in the first year just so you could take a loan. It's just like, in the end, you end up paying more interest to the insurance company than was really necessary.
Mm-hmm.
And so we've helped many people see this, that want to fund large purchases out of their insurance policy from day one.
Mm-hmm.
Well, in Mr. Nash's book, that never happened. He took 4 years to capitalize the policies, typically. And sometimes it takes a little bit longer to capitalize a policy today, like he did. That doesn't mean we have to wait 4 years or 7 years to make our first loan, but to make a large purchase, it usually does mean that, because when you pay a premium, the IRS does not allow a large enough portion of that to appear in cash value the first year without making the policy taxable. And so if we add term riders, now we're paying unneeded costs for insurance, and that's going to drag down the efficiency of the policy. It's also going to then force us to pay interest on money that was ours that we wouldn't have had to pay interest on to begin with if we had just used that money without buying insurance with it.
Mm-hmm.
And, so when we work through those little nuances, we find that if you need to make a large purchase the first year you make a policy, it's better to start with a smaller policy. Use the cash you have on hand to make the purchase, or to pay down some debt. Sometimes it's better to do that. Now, at the same time, you need to start the policy, because compounding growth takes time to compound in your favor.
It does.
And so that's why the design and the engineering of the policies is so important, and you need to work with someone like Life Benefits to make sure that you're getting a policy that fits your needs and doesn't just accelerate the commission the agent that's working on the case is going to get paid.
So we have a couple of ingredients working here: the policy design, and secondly, the money management part, the cash flow that is involved when you do take a policy loan. And the policy design part, we're talking about how maybe it's not always best to use a term rider, but there are certain cases where it makes sense to use a term rider. If you want to get extra money into the policy, maybe you do need to take a policy loan in the first year, but it's going to be paid back fairly quickly, and you don't anticipate needing that money again very quickly. Well, that might be a case where a term rider would be appropriate. So there's not a hard, fast rule when it comes to the policy design, but these are some general observations that we have noticed over our years of designing policies and our experience with this. So policy design, one component.
Yeah, and a term rider is very, very effective on someone who later on in life wants to build a larger death benefit, and not have to pay excessively for that death benefit. So adding a term rider to a whole life policy can be very helpful in someone 65 or older, to help build a substantial death benefit.
Yes, and I've even used a term rider on somebody that's in their 20s. They're not intending to borrow from the policy right away, but they're wanting to accumulate a certain amount of money by a certain date so they can make sure they have the taxes that will be due when their student loan balance is forgiven.
That makes sense. But just to turn around and borrow it out in year one rarely does make sense.
Right. So this is the policy design aspect. Let's talk about some of the money management side of this. And some to be able to understand what's going on the money management side, it will be helpful for those of you who are so inclined to download the calculators from moneytools.net. Go to moneytools.net, go to the resources and financial calculators. You can download those and work with different examples in the time value of money. Time value of money can either work for you or it can work against you. A future value calculation would be taking a certain amount of money today, putting it in for a certain amount of time at a certain interest rate, and watching how much that will grow to over that time. That would be a future value calculation. Another type of calculation would be for a loan. You have a certain loan amount. You're going to amortize it over a certain period of time at a certain interest rate, and you can calculate the payment, the monthly payment that would be due then on that. And there's different variables, obviously, that you can put in. Maybe you make payments once a year. Maybe you make payments once a month. Maybe the interest rate is compounding monthly, as it does on most loans, or maybe it is compounding annually. Policy loans compound annually.
And maybe the interest is prepaid for the first year, so it doesn't compound for the first 12 months, like like many policy loans. And so, therefore, the total amount of interest is going to be less on that loan than a loan that compounds at the end of each period.
So what's an example if we look at if we look at doing a policy loan? What are some of these calculations that we need to be aware of?
Well, I think we need to first of all be aware of whether the interest is compounded from the beginning or the end of the loan. I think we need to be very aware of the time period. How long are you going to have the loan outstanding? And then we need to consider what kind of money are we going to save because we're refinancing something, or how much money are we going to make because we're using the borrowed money to make an investment. And let's just walk through a scenario of saying that we can make a $10,000 policy loan and earn 6% on it.
Okay.
And let's say that...
So that would be a future value calculation.
That's a future value calculation, yes. And so if someone has a policy that had a term rider added onto it so they could get an extra $4,000 into their policy in year one, they have more cash value in their policy than someone who can only put the $10,000 initial premium in that. In fact, if you put a 35-year-old putting $10,000 into a policy is going to have around $6,851 of cash value.
And that's at the end of the year. Okay. Into year one.
If they put an extra $4,000 in, that's going to bump it up to $11,028.
Okay.
So obviously, someone's going to say, "Oh, you've got more money here that you can invest because you can borrow that $11,000 and invest it, earning 6%. You'll make more than the person who didn't." But we're missing a component here. That person who didn't put the $4,000 in still has $4,000
in cash.
So they can add $4,000 to their cash value, and now they have $10,851, which is still less than the person who put the extra into the policy to begin with. So ultimately, over the next 10 years, if they both invest that the first person investing his $10,851 and the second person who put the term policy on, term rider on, he can invest $11,028 to start off with.
So what do we have there? About $76 difference?
Yeah. So the one person, makes a little bit more, but here's where the cost comes in.
Okay.
You've got to pay interest on that $11,028.
Yes.
And over the 10 years, if they pay the interest on that, that ended up costing them $5,514.
And what is the policy loan rate here?
It's 5%.
5%.
And they're just paying the interest on this because they're using the principal that they borrow to invest with, and they don't necessarily have the cash flow to pay that loan back.
Sure. So it's an interest-only loan.
It's an interest-only loan.
They're paying back. Okay.
Whereas the first fellow that didn't put the term rider on there, he only had to pay 5% on the $6,851 he borrowed, not the $11,000.
Right, because
so
he
paid
added
less
an
interest.
extra $4,000 in cash to it.
That's correct. So when we get to the end, the person who added the term rider ends up profiting 37, almost 38% less than the fellow who didn't add the term rider, even though they started out with less capital to invest with. And that's why Nelson Nash always wanted to make sure that we were maximizing the policy by minimizing the death benefit, maximizing the cash value with whatever is most affordable and comfortable for the client to pay in premium.
Not necessarily with those term riders. Okay.
Yeah.
So with this example here, some people would say, well, the second person that put the term rider on the policy is paying more in interest, but some of that interest profit, if you recover the interest profit in your policy, would that person come out ahead because they're paying more interest?
Well, that's a misnomer because you don't necessarily recover all the interest in your policy, especially not in the first 20 years.
So you're paying that interest to the insurance company.
You pay that interest to the insurance company, that's right. And dividends in a policy do not get significant enough until after 20 years for you to start thinking that you are recovering interest that you paid. It's
So it's a time thing. If the longer you have the policy, the growth in the policy can offset the interest.
yes.
But it depends on how often you're using those policy loans.
Now,
And
what
the money does go to the insurance company.
What Mr. Nash said that you're recovering the interest, like on the truck leasing example in his book, and that was because he financed the truck completely, paid the same payment he was paying to the leasing company back to him, his policy, which paid for his annual premium. It paid for his base premium. And then what was left continued to buy paid up insurance. So he wasn't recovering at all because still part of it went to the insurance company.
The policy was just growing faster than the interest he paid.
That's right. But the payment that he was paying to the leasing company was now paying the premium, the base premium on his policies. And that is an overlooked fact that many people don't see because he doesn't list it out in his illustrations. But when you get down and break those down, that's exactly what's happening. It's the only way the policies can grow that fast.
Yeah, that's a great point. So when we're looking at this, so that kind of gives us an overview of the money management side. We have a couple of elements going on there. One, the earnings on the investment that's being made at 6%. And maybe that's an investment, or maybe it is interest that you're saving on a debt that you had already. That can be an investment in refinancing your debt. And then on the second side of the coin, we have the interest that is being paid on the policy loans. And so those are the two components that are at work here. And when the interest rates are different, we're making 6% on the investment, we're only paying 5% on the policy loan. Obviously, there's some profit there. What happens to that profit?
Well, that profits can go back into a policy if it still has room for paid up insurance to be purchased without becoming a modified endowment contract.
Could someone use it to pay the base premium too, kind of like Mr. Nash did in his illustrations?
Certainly they could.
Sure.
Yes.
Okay.
But ideally, someone should pay their premium based on the 10-20-70 principle. And so
what's the 10-20-70 principle?
So they should be keeping 10% of their income to pay premiums with.
Okay.
And so that should stay consistent. So when that extra premium comes back, then it's time to be thinking, is this extra interest that the insurance company isn't charging me that's coming back in this payment, is it adequate enough to start another policy? And Mr. Nash even suggests this in his book, is that the financing of the log trucks, it became less efficient the more financing did out of one policy. And now you've got to think, how much money do you want to get into life insurance before you retire or before you start using it for passive income down the road? And now you've got to say, oh, do I want to buy that insurance when I'm 35 or when I'm 70?
Good point.
And so it becomes very beneficial for us to start multiple policies while we're younger, because that premium is going to remain the same for the rest of our life at whatever age we bought it at. And we're going to be able to get a lot more capital into that than if we wait until we completely fund the policy and it won't hold any more paid up insurance, and then try to get one later in life and have to pay for it at a higher age.
That's a good point. So we can't wait to see what the future is going to hold before starting a policy. I think that ties into one of the questions I had listed here on my notes for the show today. What if we don't know what opportunities are coming up in the future? Should we hold off on starting a policy that we can just to see if there's going to be an opportunity that comes up where we can use our cash rather than taking a policy loan? Or do we go ahead and start the policy and then take a policy loan if and when that opportunity shows up?
Well, that's where the equation that we use at Life Benefits, hard work plus education plus mutual respect times our faith, will create wealth.
Life Benefits formula.
We're talking about the future. Nobody knows the future. We got to, by faith, act on what we believe is right today. And there's no right answer for that. We have to realize that if we don't start the policy, the compounding is not going to start in our favor. At the same time, if there's an opportunity today and we pass it by to buy a life insurance policy instead of taking that opportunity may never happen again in our life. That's a personal decision based on your faith, not mine.
Mm-hmm. That's a good point. Good point. Now, what about, I don't think this show would be complete without asking about what about borrowing from one policy to finance another policy? So you can get these policies going when you're young, get that insurance while you're young, but you can still work with some other opportunities as well. Is that a way to accomplish both, or could that be a strategy that ends up costing you more than it's worth?
Well, this is again a time value of money and an interest question, and interest compounds against us when we borrow money. That's something Einstein said we should never allow to occur, because it's the eighth wonder of the world, according to some people that have said that was a quote from Einstein. At the same time, it doesn't make sense to be paying more interest to somebody else than what it would take for you to start a policy. And so when we work with people that have come to us with credit card debt or a revolving debt that is really bleeding them to death, they have to start a policy now, which is kind of helping counteract the bleeding of the interest they're going to someone else. And it takes a little bit longer to get them out of debt.
Yeah, usually
than just paying off your
year.
debt, because you're actually purchasing an asset. But at the end, what happens is they have something rewarding that they've accomplished. And so they don't just turn around and get right back in debt again, because they feel like they've accomplished something. And that's really, really important. I say it's like fad dieting. You know, these people that go through debt reduction courses or use programs from the famous gurus in finance that tell you to cut up your credit cards and pay your house off and live off cash and this and that and whatnot. When people go through those courses and they end up getting rid of all their debt, they have nothing to show for it. And so just like the person that starves themselves to get down to their ideal weight, and then they feel, oh my goodness, and they go out and just binge, and the next time you see them, they're heavier than you've ever seen them before. That's what happens with these people that are going through these debt reduction programs that don't have any assets there for them to see that they did something other than just lose the debt.
Yeah.
And so that's a combination. You do it simultaneously. And it's an art. It's not going to be the same for everybody, because some people have different objectives in mind. And so that's why each of these policies and programs that we help people refinance and get rid of debt with, they're all individual. They're not plug it into the box and what comes up the other side is a fit for all.
Yeah. Paying off credit card debt is usually an easy one to see. You want to get an asset building for someone. We base that on the 10% of their income. That's the policy premium. And then as you transfer the debt to your policy, now you're actually building an asset, and you have the death benefit protection that comes along with it while you pay off the debt. That makes a lot of sense. When it goes to financing another policy, now you're bringing on a new debt to finance a new policy. Now, if you know the cash flow is going to be there to repay the premiums at a certain point in the future, maybe that makes sense. If you don't, that's taking a gamble on the future. It is,
because the compounding growth in one policy is really not going to offset the interest costs on the one you're borrowing from to finance the second.
Exactly. So if you're planning to do that long term, that's not a good long-term strategy. Yeah. Very good. So we've covered a lot in the show today. We have more information on the topic of policy loans. Maybe we'll do another show on this, because I think we're getting close to the 30-minute mark. But the takeaways from today's show, you have the policy design aspect. Inherent life benefits, we help you with that. You also have the money management aspect, and we can answer questions for you about the money management aspect as well. We help our clients with this all the time. So feel free to give us a call, 702-660-7000. Get those calculators downloaded from moneytools.net. That'll help you with those things. And then just use your brain. Use common sense to think about, when does it make sense to take a policy loan, or when would it make sense to use other funds that are available in my life?
You know, I just can't leave this podcast without this warning from Mr. Nash. In his book, he said it's going to take 20 to 25 years to build a system of policies to finance the things you want to finance in your life. 20 to 25 years. Now, we've been doing this about 16 years personally. I'd say he's pretty close to accurate. You know, you cannot finance everything that you want to finance from day one. And I think when people try to rush that, they get into trouble financially. They get frustrated. They give up. And the people that buy life insurance to get rich quick are very disappointed, because life insurance is not a get rich quick tool. It's a steady, consistent, guaranteed growth for the rest of your life. And the more policies that you can add that are affordable and comfortable as time goes on, the better off you'll be.
Agreed. Yeah, I think everyone who goes after a get rich quick type idea will always be disappointed, and that's what makes life insurance so valuable, is because when people are really looking for the guarantees, they find them with life insurance. But with so many other types of investments, people think that they're going for something stable and long term, and they get disappointed when they find out that it didn't perform the way that they wanted. Well, with the life insurance, you know you can count on it. You don't have to go chasing the get rich quick schemes to try and make up for time that was lost later in life.
That's right.
So you were listening to Wealth Talks with the McPhees. We'll be back next week.